What are you looking for from today, from the Investor Day, and what are the questions you want answered?
Well, most of the metrics that they've put out in their 111-page slide release are fairly positive. But I would say they're in line with expectations. I mean, some of the key metrics would be an improvement in ROTC up to 17%, an improvement in pre-tax income to 44 to 47 billion, an improvement in pre-tax margins in key businesses like wealth management, improved top-line revenue growth. So they're all showing improved metrics, but I wouldn't say they're out of line with what expectations were coming in.
Charles, just in terms of this particular tax bill that's come through, how much of this is going to get competed away, so to speak, and how do you see that evolving?
Well, JPMorgan has talked about the tax bill adding about 300 basis points to their ROTC and adding about $3.5 billion to their bottom line. So it is a positive. But if there was a negative so far in the slides that were released, it was their projection of non-interest expenses coming in around $62 billion in 18. That's above the $61 billion that people were expecting. So it does say they're going to take some of that tax windfall and spend it, to build the businesses.
Just in terms of the competition that could materialize off the back here, Charles, I'm trying to get my head around how it comes through. Is it through the pressure on loan yields? Is it through deposit betas? Is it through the card rewards business? Is it through fees that get cut? Where does it come?
Well, I think the big delta going forward is going to be the deposit beta. That's been running around 20%. It's probably going to move up to 50%. Even with that, though, the company is expecting, fairly good top-line net interest income growth, up to about $54 billion in 18. Now, what I will point out is it was interesting. They did project a slower loan growth. They had been growing their core loans at 9% last year, and they're projecting that to slow to 6 to 7%.